Welcome back to Tesla Daily News Podcast. Today is Friday, April 24th, 2026. We're breaking down the Tesla headlines that matter for Tesla: earnings, spending, robotaxi expansion, Berlin production signals, and what all of this means for margins, cash flow, and valuation. Let's start with the big driver of the week, Tesla's first quarter results. Story 1. Tesla beats on profit and cash flow, but investors are debating what it means. Here's the hook. Tesla put up a cleaner quarter than many expected, and still managed to spark a sell-off. Context: after a soft stretch for global EV demand and noisy sentiment around Tesla's AI pivot, investors wanted proof the core business can still fund the future. Details: Tesla reported first quarter revenue of about $22.4 billion, up roughly 16% year-over-year. Net income came in at $477 million, up about 17%. On an adjusted basis, earnings were about $0.41 per share, above the consensus estimates cited in multiple reports. Deliveries were 358,023 vehicles, up about 6% year-over-year, while production was 408,386, up about 13%. Free cash flow was about $1.44 billion, a big swing versus expectations that had leaned negative. Impact: the stock reaction was mixed to negative because investors are focusing less on one quarter's beat and more on the forward spending ramp, the delivery growth rate, and whether Tesla's next revenue engines, robotaxi and Optimus, will arrive on schedule. Takeaway: the quarter shows Tesla can still generate cash, but the market is treating this as a transition story, not a traditional auto earnings story. Story 2. The $25 billion capex bombshell and why it hit Tesla. Hook: Tesla just raised its 2026 capital spending plan to more than $25 billion, and the market immediately flinched. Context: Tesla is trying to transform itself into an AI, autonomy, and robotics platform, and that requires huge factory and compute investment. Details: Tesla lifted its annual capex outlook from around $20 billion to more than $25 billion, versus about $8.53 billion last year, nearly a tripling. Elon Musk highlighted spending across factories, robotaxi build-out, AI compute, and robotics. Several market reports noted Tesla expects negative free cash flow for the rest of the year after the first quarter surplus. Impact: higher capex can be bullish if it accelerates high-margin software and autonomy revenue. But in the near term, it pressures free cash flow, and it forces investors to underwrite in proven businesses. It also raises the bar for execution and increases sensitivity to any EV margin compression. Takeaway: for investors, the question is not whether Tesla can spend. It's whether that spending converts into recurring, high-margin revenue before the market's patience runs out. Story 3. Robotaxi expansion in Texas is real, but the revenue story is still early. Hook: Tesla is expanding its driverless robotaxi footprint, but Wall Street is still waiting for proof of scale and monetization. Context: robotaxi is central to Tesla's Tesla is an AI company valuation narrative. If it works, it changes the margin profile. If it lags, Tesla is left with an auto business facing fierce competition. Details: multiple items in the feed point to Tesla expanding robotaxi operations beyond Austin into Dallas and Houston. At the same time, coverage noted the robotaxi fleet is still small, and in some reports it still relied on safety drivers. Musk has also said robotaxi is unlikely to contribute meaningful revenue before 2027. Impact: expansion headlines tend to support the long-term autonomy thesis and can move analyst sentiment, but the near-term stock impact depends on regulators, safety performance, and the pace of city-by-city rollout. Investors should watch for measurable metrics: miles driven, disengagement rates, unit economics, and any hint of paid ride volume. Takeaway: robotaxi is progressing, but it is not yet a material revenue line, so Tesla remains extremely sensitive to expectations and timelines. Story 4. Hardware 3 cars may not reach unsupervised FSD, creating a retrofit and liability question. Hook: Tesla is now acknowledging that older Hardware 3 vehicles may not be capable of true unsupervised full self-driving. Context: Tesla has sold FSD packages for years, and the promise of autonomy is embedded in customer expectations and, indirectly, in investor expectations. Details: reporting from Hungary's Origo cites Musk saying Tesla long believed Hardware 3 could reach unsupervised autonomy, but that appears not to be feasible. Two possible paths were discussed: upgrading customers to Hardware 4 via a vehicle swap path, or retrofitting Hardware 4, potentially including camera replacements. Exact program details and timing remain unclear. Impact: if Tesla must retrofit millions of vehicles, that's a cost and logistics challenge. It could also create revenue opportunities if handled as an upgrade pathway, but it risks customer dissatisfaction and potential regulatory or legal scrutiny depending on prior marketing and customer purchase terms. Takeaway: for investors, treat this as a margin and capex wildcard. Watch for Tesla's formal policy, estimated per vehicle retrofit cost, and whether it becomes a material drag on services gross margin. Story 5. Gigafactory Berlin staffing and production plans suggest improving European demand, but investors should stay cautious. Hook. Tesla says it will add about 1,000 jobs at its Grünheide, Germany site, signaling a planned production increase. Context: European demand has been a question mark for Tesla amid broader EV competition and shifting incentives. A production ramp in Berlin could help reduce delivery times and logistics costs across the region. Details: multiple European outlets report Tesla plans to hire about 1,000 workers by the end of June. The goal is to raise weekly production about 20% starting in the third quarter, taking output to roughly 6,000 Model Y units per week. Tesla also expects to convert about 500 temporary workers to permanent roles and is recruiting several hundred additional staff for battery cell production expected to start in the first half of 2027. Reports also cite strong gains in Tesla's EU performance, including ACA-based numbers showing first-quarter EU registrations of roughly 57,800 vehicles, up about 59.6% year-over-year. Impact: hiring and higher output can support revenue growth and improve fixed cost absorption, which is good for automotive gross margin if pricing holds. The risk is that a production ramp into a weakening macro environment could increase inventory pressure. Takeaway: Berlin looks like a positive demand signal today, but investors should cross-check with inventory levels and price actions in Europe over the next 2 months. Story 6. Tesla's energy business had a rare down quarter, while the AI-driven grid theme stays supportive long-term. Hook. Tesla Energy is still a critical part of the long-term thesis, but this quarter showed softness. Context: Megapack deployments and grid storage have been one of Tesla's strongest growth narratives, especially as AI data centers push electricity demand higher. Details: one earnings recap reported Tesla's energy generation and storage revenue fell about 12% year-over-year to about $2.41 billion. Meanwhile, a separate energy and AI infrastructure article highlighted the broader trend. Data center electricity demand could rise from roughly 448 terawatt-hours in 2025 to nearly 980 terawatt-hours by 2030, with AI servers driving a large share of the increase, and Tesla's Megapack positioned as a grid-stabilizing solution. Impact: investors typically like Tesla Energy because margins can be strong and the market is massive. A down quarter may pressure near-term sentiment, but the macro tailwinds from AI electrification remain intact. The key is whether Tesla can scale deployments and maintain pricing power. Takeaway: watch Tesla's next updates on Megapack backlog, deployments, and gross margin. Energy is still a strategic diversification lever, but it must show consistent execution. Now let's zoom out and connect the dots for Tesla. Right now, Tesla is trading like a hybrid, part cyclical automaker, part AI and robotics call option. The earnings beat and strong free cash flow show operational resilience, but the larger story is the spending surge to chase autonomy and robots. That makes near-term volatility almost inevitable, especially around guidance, regulatory headlines, and any sign that vehicle demand is slowing. Before we wrap, a quick list of what to watch next. First, any concrete disclosures on the capex breakdown, especially how much is going to factories versus AI compute. Second, a clearer robotaxi rollout schedule and whether Tesla can demonstrate consistent, safe operations across more cities. Third, any formal Hardware 3 retrofit plan and the potential cost per vehicle. And fourth, signals on European pricing and inventory as Berlin ramps production. That's it for today's Tesla Daily News Podcast, Friday, April 24th, 2026. If you found this helpful, subscribe so you don't miss our daily breakdown of what's moving Tesla's business and Tesla stock. See you tomorrow.